Hi everybody, this is Mike Schuman from Vermont VA Federal Credit Union and welcome to Show Me the Money. Today we're going to talk about a variety of subjects. Obviously it's all about personal finance, it's all about success. We want our members and actually prospective members who live in the Upper Valley, if you live, work, worship, or attend school in Grafton or Sullivan County in New Hampshire or Windsor Orange County in Vermont, you're eligible to join our credit union. So everyone within the distance of my voice is eligible to join, or you are a member, and we want you all to be out there and succeed. So that's our bottom line. Today we're going to talk about a couple subjects. First and foremost, we're going to talk about something near and dear to our heart as a credit union, because we like to put the credit and credit union. We've seen a pretty good size uptick in loan applications. And for those people who are qualified, it's great. We'd love to say yes. And for those people who are struggling for whatever reason and we can't say no, we like to say no now, but we'd like to find a way to get to yes. And that's the distinction between banks and the credit unions. The credit unions are all about finding ways to get to yes. So there are a few things that you need to be focused on if you're interested in getting a loan. And we're talking about a variety of different loans, even a credit card. We're talking about a personal loan or a car loan or an RV loan, or getting to the season where a motorcycle loan can be fun, a house if you want to buy a house, or even if you have a rate of 5.5%, 6% or over, you know what? Refinance your mortgage, save the money. Don't have loyalty to a financial institution you're overpaying interest to. What you want to do is you want to refinance and put the dollars into your pocket. And then what do you do? Well, that's part of what we always talk about, is getting to that financial success. It's about living beneath your means, saving, investing, and going to what a great master of personal finance with a radio show calls critical mass. You want to get to critical mass. In fact, there's been some stories about a large percentage of Americans who, if they get hit with a $400 bill, medical bill or car problem, et cetera, most Americans would have a struggle to get to that $400 bill expense. So what we want to do is we want to find ways to make sure, you know what, life happens, expenses happen, so we want to make sure that you're able to be in a position to come up with the $400, or if you have good credit, you can come to a credit union like ours and get a loan for $500,000, whatever the circumstances. And actually we had a member recently who had a dental problem, and she had a dental bill, and we were able to help her out because she didn't have the money, but because she had good credit and she was a good long-standing member, we're able to help her out. So it always starts, as far as getting a loan, with good credit, of course, and that is the most, that's the starting point for so many of the loans we look at. And if you have good credit, the world is your oyster. If you wanted to get a personal loan, that is the most important thing, because a personal loan or a credit card is unsecured by any sort of collateral. And when I say collateral, I'm talking about cash collateral, car, RV, motorcycle, home. That is security, because lenders think this way. What happens if I don't get paid? Well, if I don't get paid with a personal loan or a credit card, my options are limited because I don't have security or collateral. But if I have an RV or a car or a house, we hate to repossess or foreclose. We hate to do that. But if we don't get paid, then at least we do have security. We have the collateral. So the starting point is always good credit. And we'll get to, we're talking FICO towards the end of this. But that's the starting point. Have good credit. The next thing you need to look at, or we need to look at, is cash flow. Not just the income that you have, but also the income relative to your expenses, your other loans that you have outstanding. We call it a debt-to-income ratio. So we look at your housing payment, we look at car loans, personal loans, student loans, credit cards with balances, everything. Any loans that you have outstanding, we divide it by your income. We try to keep that number as low as possible. 45% or less generally with a mortgage. There's some circumstances we can go above that for a mortgage we put in our portfolio. For a home equity loan, home equity line of credit, or any sort of mortgage, we can actually go a little above 45, which is unusual in the industry because most lenders sell their mortgages to Fannie Mae or Freddie Mac, who make the rules. Fannie Mae, Freddie Mac say 45%, not 45.00001, 45. So if you go above that, a portfolio lender like a credit union makes a lot of sense. So we look at your income, we look at employment, we look at credit. So those are the most important things that we are looking at for sure. If you're buying a home, or even if you own a home, we want to make sure you have equity. equity for a refinance means that the house is worth more than you actually owe. So that's always a good starting point. And on a home equity loan, obviously you need to have equity as well, home equity loan or line of credit. But if you're buying a property, you need to put cash into the deal. There are some deals out there like VA loans where you don't need to put any money down, and that's fair. But there are some circumstances, or many circumstances, where you need to come up with a cash down payment. And we have some strategies associated with that. So once again, we always talk about living beneath your means so you can save, invest, buy property, etc. So that's really one of our goals as part of our program for success, which we call Take Control, because we want you to take control of your personal finances, because a lot of folks don't do that, and when they don't, then they're setting themselves up not to succeed, and we want people to succeed for sure. We even have solutions if you are struggling and you need a car. You need a car to get to work or to medical appointments or what have you. We have a partnership with an organization called More Than Wheels, where they actually will work with you over a period of time to get in a position with your credit and your cash and everything else, your credit most importantly, to make sure that you're able to buy a car. And when then, at that point in time, when you've passed their program, they have relationship with dealers so you can get a discounted price. They have relationship with us, so you actually get a nice car loan rate, which is very attractive as well. So it makes it easier, more economical for you to have a new car with no maintenance issues. Usually a new car with really good gas mileage, even though the price of gas is relatively low, why spend more than you actually have to? That's always part of the deal. You know, this is personal finance, it's economics, so you want to succeed, then you utilize these tips to the best of your ability. So I mentioned about collateral. That's one of the things we like to look at with a loan. Not always do we need to have collateral. We just did a nice big personal loan for a nice family. They were doing some home improvements and they just didn't have equity in their property, and that does happen. But they had excellent jobs, good income, kept their debt under control, so their debt to income ratio was good. And their credit was excellent. So in that circumstance, we were able to help someone literally just a couple days ago. So we're in the business of helping people out who help themselves. And if they struggle or they've had past struggles, we want to help them put themselves in a position so they can reach their goals, getting a car, fixing their house, so on and so forth. We've talked in the past about, we're talking FICO. Now, this is a big deal because we want to make sure that you have the highest credit score possible. And when you get the highest credit score possible, just about everyone nowadays is pulling your credit when you do something, when you want to get a loan, when you want to get a job, your insurance. They check your credit as well because they consider your credit a risk factor. And the higher your credit score, the less likely you are to be a risk to them. And the lower your credit score, it's an issue of personal responsibilities there for concerned, and they consider you a higher risk and they can charge you higher premiums. So your higher credit score is going to lower your payments on loans, which is great. It's going to lower your insurance payments. It makes it more likely that you'll reach your goals of buying things by financing them and also getting the insurance that you need and also getting a job. So there's very little downside to having a high credit score, and there's a lot of downside to having a low credit score. So go to annualcreditreport.com. Every year, it's a free credit report. Does not provide your score for free, but it does, for a small fee, allow you to get your score. So focus on some of the key things that we do as far as FICO, Fair Isaac Company is FICO, credit scoring. What's the most important thing? Payment history, 35% of your score. If you pay your credit on time, you will generally have a higher credit score. That's just a reality. It's 35%. It's more than a third of your score. So you want to make sure you pay your bills on time. The next biggest issue is your credit utilization, usually your balance to limit ratio on lines of credit, okay? Now, bottom line, you want to use credit wisely and sparingly. That's the fundamentals of FICO credit scoring. So you pay wisely, you pay on time, and you don't abuse credit, you don't close out accounts. Credit utilization is very important, and here's how that works. Let's say you have $10,000 in credit limits, all your credit cards, home equity line of credit, overdraft protection, all these things, $10,000. Now, if you owe $500 on all of them, that means that 95%, $9,500 is available. That means you're generally, if you pay on time, you're going to have a higher credit score. Now, let's look at the opposite. Let's say you have $9,500 in balances on a $10,000 in limit. In this example, you are probably going to have different limits than anything else. That's why you do not want to close out your credit cards and so on and so forth. Let's say an annual fee or something like that. But if you're at 95% of your balance to limit, your score is going to go down, and it's going to go down pretty substantially. 50% is usually the area where you don't want to go above. You want to keep it to 50% utilization or lower. If you're at 5%, obviously you're going to have a higher score than if you are at 50%. Keep your credit cards open. Keep your lines of credit open. Don't close them for that reason. The other reason is age, because the oldest line of credit could be a credit card. And if it is, your oldest line of credit can be a determining factor in your credit score. New accounts can be a factor in your credit score. Inquiries are a small negative, usually 3 to 5 points. Don't go crazy about it. If you need to buy a car and you're going to be financing it, you're going to have an inquiry, a credit inquiry. So that is not a driving factor. Driving factors to a large degree are how much credit you use and how well you pay. So those are some of the key concepts, okay? So remember, 35%, pay on time. 30%, keep your balances low on your credit utilization. Don't open accounts unless you absolutely have to. And the older your credit balances that you have, the older that you have your credit, lines of credit, etc., the better your credit score is going to be. Use credit wisely and sparingly, and your credit score will be higher. Lowering your payments when you do get loans, making you more likely to get the job that you want to get, lowering your insurance payments, and allowing you to live beneath your means. And in the next segment, we're going to talk about what to do when you are living beneath your means. Welcome back. I'm Mike Schuman with Vermont VA Federal Credit Union, and this is Show Me the Money. So we've been talking about a variety of things. Obviously, we want to talk about your financial success. It's very important to you, and it's important to us as a credit union. We're a nonprofit financial cooperative, and we are a membership-owned cooperative. So we want our members and our prospective members to succeed. That's what we are all about. So we were just talking about credit, loans, etc. And we want you to be in a position where you're maximizing your income, and doing that through having high credit can be helpful because you're more likely to get a job if you have a high credit score. Keeping your payments low, doing that by having a high credit score. Keeping your payments down so you can ultimately live beneath your means. So, what are you going to do with excess money? What can you do? And this could be anything. This could be a tax refund. This could be the fact that you're living beneath your means, which is so important. 1, build up your emergency fund. It's always a good idea to have 6 to 9 months worth of emergency cash to make sure that just in case something happens, as I mentioned before, the average American is not prepared for a $400 bill, okay, for medical or dental or fixing your car. Well, don't be in that situation. Build up emergency savings. That's one option when you're living beneath your means, okay, or a tax refund or anything that you come into. Number 2, pay down debt. Now, I just talked about credit, getting credit, which is great. You want to get credit when you need it. You need a car, you want to buy a house, personal loan. As I mentioned before, we had a nice couple that came in and got money for home improvement. They want to fix their home because the value of their home, they didn't have enough equity, so they fixed their home. They can actually increase the value of their property, presumably, which is a nice situation. But that doesn't mean they want to have the debt there forever. So if you're living beneath your means, you're going to pay down your debt. So that's the second option, where you have living beneath your means or you have a tax refund or a windfall of any kind. Number 3, once again, you want to build critical mass. You want to build wealth. Being able to do that through saving, which is good, putting in money in an emergency fund, that builds your wealth for sure. Paying down debt actually builds your wealth too, because wealth, your net worth is determined by your assets, your house, your car, stocks, bonds, et cetera, less your debts. So if you're saving more money, or if you're putting more money to the 401k, or if you're paying down debt, everything that you do in that circumstance is building your net worth so you can get to critical mass, which is what I just talked about before in the prior segment. Okay? We do have some good news on the retirement front. Americans are saving more in their retirements. They're not saving outside their retirements because most don't have the $400 we talked about. That's great. The bad news is we're nowhere near what we need to save for retirement savings. And a lot of us think of that $1 million figure to get to that, which is very daunting. I've actually seen recent articles saying 2 million is the new 1 million. Well, that's even twice as daunting. And you know what? That's scary. You just got to start somewhere. Start saving, and when you're younger, invest it, because time is your friend and you need to manage that risk. So over time, you will see the benefits. And I always go back to, what was the stock market trading at 10, 15, 20, 30, 40 years ago? Because time is your friend if you're young. If you're older, you've got to be more conservative. And it's completely understandable, because you don't have the time to make it back in the stock market, because we don't know what it's going to do short term. It's going to gyrate. Day to day it gyrates. I have no idea what it's going to do. Warren Buffett is the greatest investor of all time. He was on TV the other day. He doesn't know what it's going to do day to day, but he does know this, and I know this. Over time, you will benefit, because 40 years ago, the Dow Jones Industrial Average, which is around 18,000 as of the shoot today, 40 years ago, it was about 1,000 to 18,000. That's time benefiting you. 30 years ago, 35 years ago, it was about the same. In 1987, there was a stock market crash. Well, it went from something like 2,500 down to about 1,800, 1,500, something along those lines. But once again, it's 12 times that now, from 1,500 up to about 18,000. And over time, the stock market has been a good investment. Short term, it doesn't work out well. Be aware of one other thing. There's a rule out there called the Rule of 72. What the heck is the Rule of 72? The Rule of 72 is 72 divided by whatever rate of return you're getting is the time it takes to double your money. Historically, the stock market has gone up 8 to 10% on average. Does that mean that it's going to do that steady every year? No. It means that some years it's going to go up, some years it's going to go down, it's going to fluctuate. But if you think about it this way, if you say it's going to go up 8% per year over time, over your lifetime, which is not unreasonable to expect, 72 divided by 8 is 9. 9 years to take your money to double. So you put $1,000 away, and at that rate of return, it'll double in about 9 years. That's not too bad. I want to put it in a different context. Let's say you are able to find a place that offers you 1% on a savings account. 1%, and that's tough to find nowadays. 72 divided by 1 is 72. Your money will double in 72 years. Well, that doesn't make much sense. If someone has that much time on earth, then ultimately you should be putting money into a riskier investment. Talk to a financial advisor, an index fund, something like that would make a lot of sense. But if you're getting close to retirement age, if you're 60, in your 60s or thereabouts, risk is not your friend. So you want to put it in something because you want to preserve capital. It's not about your return on your money, it's a return of your money, which is very important, obviously. So one of the next things to do with living beneath your means, or a tax refund or a special windfall. Put the money towards a necessary large purchase, like a furnace or car repair. So that's something else you can conceivably do. If you have kids, open or add to a 529 college savings plan for your kids. So there are a lot of options out there. All these are good ideas, but before you take anyone else's recommendation, including mine, for the wisest way to use your tax refund or any sort of windfall, assess your family's particular needs. It's important for spouses to discuss this. I want you to remember the basics, as we've been talking about to a large degree, this in the prior episodes of Show Me the Money. Live beneath your means. I talk about it all the time, banging you over the head, banging myself over the head. Try to live beneath your means. Make sure you're not in the most expensive house that you have because you could conceivably qualify for a mortgage like that. Then you're just making your cash flow situation a real struggle. So you're going to be aware of that. As I mentioned, the $400. People don't have that $400 for an emergency, but you can afford a huge mortgage payment. It doesn't make any sense. Once again, you're living beneath your means. Take the excess. That is a surplus. Pay down debt. Invest. If you've got a longer time horizon, once again, the stock market, as I mentioned. You want to, as I mentioned before and in the prior episode, take control. You don't let circumstances take control of you. You take control of your personal finances and you will succeed and you will hit critical mass. Critical mass means enough money where you have the freedom to do what you want, to work, to not work, to travel, to do whatever you really, really want. What are the benefits of this? You're going to reduce financial stress. You've got enough money to pay your bills. I mean, that is a great situation. But a lot of people, they don't. They have this financial stress because they have not taken control. You eliminate debt. Once again, you're living in a world. If you can live in a world by the time you're 60 or 65, historically, people get to that age, they have eliminated their debt. It's going the other way nowadays. Baby boomers are going in with bigger mortgages and more debt than their predecessors, and it's not a healthy situation. They're putting themselves behind the eight ball. It's not a good situation. So when you're younger, I think the millennials are smart enough to recognize that too much debt is a problem, and I think they're living smart based on what happened in the 2008 financial crisis. Lessons are learned from this. The Depression-era babies were smart because they learned and they were scared. A little bit of healthy fear goes a long way in personal finance. You want to be a little scared so you can be a little conservative with your own money. It makes a lot of sense. One of the other benefits, living paycheck to paycheck. Well, most everyone does live paycheck to paycheck, but at some point, if you have enough critical mass, enough assets that you can live off of a sudden you're drawing your own paycheck. You put into an annuity, a fixed annuity or something like that, so you get a paycheck that you've contributed from your retirement savings over the years. It's accumulated. That is a very satisfying situation for sure. Ultimately, you can retire on your own terms as a result. Once again, we talk about this with personal finance. Take control of your circumstances. This has been Show Me the Money. I'm Mike Shuman with Vermont VA Federal Credit Union, and we are wishing you well.